Indians' growing love affair with SIPs is overwhelming. Every single day, a staggering 491 crore rupees flow into mutual funds through SIPs. That's massive, no? However, when investors begin investing through SIPs, they often make some mistakes that can disrupt their financial game. So let's dive deep into these blunders and figure out the ways to avoid them with ease. Hello and welcome to our channel 5 Minute Finance. This video is going to talk about 5 common SIP mistakes that can dampen your overall returns from SIP in mutual funds. Let's start with mistake 1, skipping SIPs. When you invest your money, you are basically putting your money to work and earn more money in the form of returns for you. Now, over time, you start earning money on these returns as well. This is known as compounding, which amplifies your wealth exponentially, creating a snowball effect. And when you skip an SIP installment, you hamper the whole process, which hits your finances really badly. Let me show you the impact of skipping SIPs. So suppose you started a 15,000 monthly SIP in an equity fund for 20 years. Now, assuming a rate of return of 12%, you would have made a corpus of 1.5 crore after 20 years. But if you had skipped only one SIP every year in this 20-year period, that means you invested 2.8 lakh rupees lesser during these 20 years. Your total corpus would have fallen by almost 40 lakh to 1.1 crores. Seems sinful, right? So be consistent with your SIPs and avoid skipping them. Moving to mistake 2, investing a very small amount via SIPs. SIPs somehow have been positioned as a way to invest very small amounts. No doubt the average ticket size of SIP investment in our country is close to 2,300 rupees only. Now, even if you stay disciplined and continue this SIP for a long term, it's not going to help you make a significant corpus for you. To understand it better, let's assume you continue this 2,300 rupees monthly SIP for 35 years. Now, at the end of this term, you will get a corpus of 1.5 crore. Factoring in inflation, the worth or value of 1.5 crore after 35 years would be equal to 20 lakh of today. So do some math and have a clear financial goal while investing. It will help you select the right investment amount. You can use the ET Money calculator to figure out the right SIP amount for your goals. The calculator also gives an option to factor in inflation. You can find the SIP calculator link in the description. Now, once you have figured out the right amount of SIP for your goals, don't forget to keep increasing it to match the rise in your income. This takes us to mistake number 3, not increasing your SIP amount. Increasing your investments is important to fight inflation and sustain at least the same lifestyle in future, if not better. You should in fact consider increasing your SIP amount whenever you receive a salary hike or experience an improvement in your financial situation. So continuing with the above example, we have seen how a monthly investment of 2,300 rupees can create a corpus of 1.5 crore in 35 years at 12% rate of returns. Now let's look at the difference in your final corpus if during these 35 years you continue to increase your monthly SIP amount every year by 10%. So you would have made a corpus of over 4 crores after 35 years. We have assumed the same 12% rate of return here as well. No doubt you invested a much higher sum here of around 75 lakh in 35 years, whereas in the case where you did not increase the SIP amount, you had invested a total 10 lakh rupees in 35 years. But we are not trying to compare the amounts here. The idea is to remind you to keep increasing your SIP amount to make higher corpus in the long term. Moving to the next mistake, opting for IDCW option instead of growth. Do not go for the income distribution cum capital withdrawal plan, earlier known as dividend option, while investing through SIPs. Instead, opt for the growth plan. The IDCW or dividends in mutual funds simply means taking a part of your investments back. It distributes profits to investors periodically. So the money which is paid out does not earn returns, obviously. Whereas the growth plan invests the profits back. The reinvested sum also earns returns. Now those returns will again earn returns. And that is how the invested amount continues to get compounded over time. And this can create a considerable difference in the final corpus. Moving to the last mistake, investing in mutual funds via SIP for the short term. the markets are in a bull phase, many investors want to ride the wave. Some of you might also get carried away by short-term, say 1 or 3-year returns and invest in funds. But past performance does not guarantee the future returns. Also, stock markets are too volatile in the short term, and there are high chances of making losses in an equity market if you invest for a short time period. See the chart on your screen. It shows how many times various indices have made a loss over 1-year period. While Nifty 50's numbers still look respectable, mid and small caps show a higher chance of giving you a loss in the short term. With small caps, it's almost 1/3 probability. So never invest in equities for the short term. Keep at least a 5-year horizon. It's better to keep a 7-year horizon for riskier categories like mid cap and small cap. Keeping this horizon will ensure a good return experience from equities. So by avoiding these mistakes, you can unlock the full potential of SIPs. Now, what is the full potential of SIPs? Well, for that, you can visit other videos on our channel. And with this, we come to the end of this video. If you found it insightful, don't forget to subscribe to our channel and share this video with others as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.